This is episode 12 of the Snowball Experiment, the series in which I invest small amounts of money on a regular basis in order to build wealth and passive income over time. In the last episode, I have explained that I was trimming my silver and gold positions because I thought the market was overheated. Turns out that from there, silver went from $100 or so to down to the 70s, low 70s, 72, 70, maybe 71 that I see here. And now it's bouncing back. It's possible that it will keep going and beat these highs, but I wanted to lower my exposure, and in this video I'm going to explain what I did as far as the rotations of money that I did, what I sold, and what I bought. So last Friday, before I made any moves, I took a screenshot of what my portfolio allocation looked like. And as you can see here, the precious metals are at 30%. So it's very high, even though my target at the time I wanted to increase my exposure to precious metals because it was in a very heated bull run. But it grew too much at some point, and I felt that the end of the first leg, anyways, of that move was coming to an end. So I wanted to liquidate that. And at the same time, I was very light on energy. I was light also on everything that's defensive, consumer staples, utilities, healthcare. All of this was very, very light. And I wanted just to change a bit the dynamic of the portfolio to make it a bit more resistant. And as we go in the next few months, I want to solidify the portfolio even more. And this is what I'm going to explain right now. So I think one of the best ways to justify the moves that I've made in the portfolio is through taking a look at the phases of an economic cycle. In the first phase, which lasts around 3 to 6 years, you have the expansion. So this is where everybody gets crazy about the stock market, and you got technology, financials, telecom, and consumer discretionary that go really nuts. Basically, the market is in a risk-on phase where people are willing to take risks, and fear is almost inexistent. It's more the fear of missing out that is present. And during that phase, this sectors that underperform are utilities, consumer staples, and healthcare, because as we have seen in previous videos, these are a defensive category. And it's not rare for these to underperform the broad market with a 5-10% annualized underperformance. Then comes the peak. We have the outperformers here, the financials, the energy, and the materials, which I believe we are in phase two right now in the US, anyways, as far as the market. And this is where technology and consumer discretionary and telecom start to lag behind a little bit. And money starts to flow back into the more defensive stocks because we're going into a contraction, and this is where you get your recessions, where people get laid off, the economy slows down, and companies start to feel the pain a bit more. And this is fairly quick as far as the length of it. It's usually 6 to 18 months. And then your underperformers are the industrials, the financials, energy, materials, and consumer discretionary. Basically, cyclicals start to underperform by 15 to 30%. And then comes the recovery. This is fairly short. This is where real estate gets its heyday, and then industrials, and money flows out of the defensive stocks, and utilities, consumer staples start to. Oh, yeah, there's a mistake here. It should be healthcare. I'll fix it later. And then you have telecom that start to underperform the market, and then the cycle goes back into expansion. So this is what kind of justifies my view of the market and how I want to make the moves that I'm making in the portfolio to try to be a step ahead of the market. Basically, right now what I'm seeing is there was an outperformance in materials, in financials, energy not so much as I've mentioned, but I believe that the money is going to start to flow into the more defensive ones. It already has started, and I think there's going to be a bit more fear in the market in the months to come. So that's my view of the market anyways. I could be totally wrong. As a comparison, here we have the S&P 500, which is the light blue line. Uh, B is the basic materials, V is healthcare, U is utilities, P is consumer staples, K is the technology, XLF is financials, and C is communication services. And you can see here that technology has been dominating, and financials are a little bit higher over the past 5 years. But the communication services has picked up in the past 3 years, along with technology, while financials have been slowing down a little bit. But what's going on in the past 3 months is that materials are now leading the pack, and also the consumer staples. And year to date, clearly you can see that consumer staples are taking over. So that means that risk is coming off, and people are selling the ones that were really sexy in the past few years, which are technology, financials, and money is flowing elsewhere, basically. So right now, the moves I'm making, I made materials the end of the year my priority, but now I'm going to go more into consumer staples and utilities, as well as healthcare. I think this is where my overponderance is going to go. So as I've mentioned, this is what my portfolio was looking at before the changes that I've made, way over pondered into precious metals. And now this is what I'm going to aim the portfolio towards. I'm going to go really heavy into consumer staples. I'm going to crank up utilities. Healthcare I've already cranked up. I'm going to try to stay away from Canadian and US equities. Canadian I'm less fearful of, but I would like to make an overponderance in those if ever there is a crash. If I see something like a 20 or 30% plus correction in the market, I will go very, very heavy. But right now, I feel very comfortable going into defensives and turtling up, if you will. So if you want to take a look, I was very over pondered here into commodities, and now I'm slowly going away from that. So what did I buy? What did I sell? I sold AGCC completely. As you can see here, I have sold also GLCL, which were leveraged covered calls. So I sold those, but I kept the high yielding GDXY and SLJY. GDXY I think is at an 80% yield right now. SLJY is at 18, I think. I've added some base materials. What did I buy? I bought some more energy as well. The consumer staples that I have right now are Conagra, Calmaine, Flowers Food, General Mills, Hormel, and International Perfumes. And we'll look at the charts in a second. What else? In healthcare, I went for GNJY, which is a covered call of Johnson & Johnson. I've also bought LLHE, which is an Eli Lilly covered call. and healthcare again. Novi, which is a covered call on Novo Nordisk, which was beat up quite a bit. I'll probably buy the regular shares as well eventually. And then I bought YUNH. I already had UNH, United Health, but I bought the covered call on it so that I could spike the yield on the healthcare sector in my portfolio. I also bought BLKY, which is a covered call on Block. Um, and these are the moves that I made. Everything else is the same, basically. So what does it look like? I have a bit of an overponderance into basic materials right now. I could buy a bit more precious metals now that the dust is settling a bit, but I'm not in a rush. I want to, I don't know if it's going to keep going. If we close a week above the current high of 121 in the silver market, I'll consider going back in because then we would go at least to 150, probably $200 an ounce. So that would be interesting to ride that wave. But I'm in no rush to do that. Full disclaimer, in my leveraged account, I bought more silver in the in this late 70s and beginning 80s. I started to escalate the position, and I'm gonna get out in the 90s, early 90s. So we'll see how that plays out. But that's beside the point. Utilities, I'll buy a little bit more. And this sensitive sector here, I won't, category, I mean, I won't touch at all. I would really like to buy more defense stocks, but right now I think my allocation should be towards these defensive sectors, and then I'll rebalance if we have a crash or something like that in the next year or two. Then I will go very heavy into equities in the US and Canadian market to try to buy some really growth-oriented stocks. But right now I'm turtling up. So let's focus on the stocks in the consumer staple category that I bought. We have Conagra here, which I believe was heading towards an area of support. Even if it went lower, I would keep buying at these green lines. But right now, I'm looking for a bounce, which has already started. I bought in this area over here a little while back. Flowers Foods, I think it's the same story. I think it went too far, too fast on the downside, and I'm expecting some type of a bounce on these levels. And it's possible that I'll trim the positions if ever it bounces too much, too far, too fast in the opposite direction. But I wouldn't be surprised if we had some type of reversion to the mean towards this trend line in the year to come or so. Cal-Maine, Cal-Maine is, I was attracted to the yield, and also they they're like the king of the egg market basically, and I'm expecting this to keep going down to the trend line, but I wanted to establish a position anyways just to keep following it and try to get some income from it in case it keeps going up. I have no idea if it's going to go to the trend line or not, but I think it's very likely. But I'm willing to buy more at a lower price. This is a buy and hold cash cow basically. International Perfume is a very high performance stock since the last 25 years or so, but it goes through these periods of really oversold territory towards that trend line here. And I bought off of a bounce, and I'm expecting prices to keep going to this zone here, probably gonna mess around or so, and then eventually break out and get overbought. And then I'll see what I do as it starts to go along this trend line here. So that's kind of my rationale. The dividend is only at 3.26%. It's not super great, but as I've mentioned, I'm trying to accomplish in the experiment um, uh, capital appreciation as well as regular income. So the only way I can think of to do that is to have both covered calls and regular dividend stocks that are trading at lower values and that keep growing their dividends over time and also increase the share price as I catch them in a down cycle just before they start to pop again towards their mean. Hormel Hormel is a different animal. This one was a beast of a stock for a long, long time, and it's the first time it went outside of that big channel. And but because the volume is increasing a lot, I decided to start establishing a position and kind of take a leap of faith. So there's no real technicals here that I'm going on of, like I'm basing my trade on, but basically catching a knife. But I do think that this is a company that I want to own for the long term, and if it starts to pick up, I could have these kind of moves that can give you 600% over 5 or 6 years, which would really beat the S&P 500 in most cases. Another one that I bought is General Mills. It pierced that support here. I think it's over sold, and I wanted to establish a position in there. It's possible that it's going to keep going down, but it's hard for me to find a better entry point than this. Of course, it could keep going, but I'll just cost average until I have too much of an exposure into it. But right now, I'm just buying little slices of these stocks. So these are the stocks that I bought. If we want to take a look at the Eli Lilly and why I bought that stock. I don't think that this is a great entry in the covered call anyways, but because I think it might bounce here. I was expecting a bounce and I wanted to buy in that area, but I wasn't able to catch it. But now it's possible that it's gonna go and test that newly found support as it broke the resistance, and then now it needs to test it. So that's possible. If it's the case, I'll probably buy more at that level. UNH. UNH has gone up a lot, and it's possible that it's going to keep going down. I was expecting this because as you can see here, I was at that point in time, I thought that it would go down another 49%, which is possible. If it does go down to the 170, then I'll go nuts on the regular stock and probably the covered calls as well, because this would give me both growth and income for years to come in that particular stock. So that's what I wanted to talk to you guys about. If you like these kind of videos, give it a like and let me know in the comments as well, and I'll see you in the next video. Thank you.